G'day and welcome to Connected With Latham, where we discuss ideas, legal developments and business trends shaping the global economy. I'm Tom Evans, a private equity M&A partner in Latham & Watkins' London office. In this episode, we discuss how creative uses of collateral present new financing opportunities for private equity. I'm joined today by a fellow partner from the London office, Francesco Lione. Francesco regularly advises investment banks, private equity firms, and corporate clients in a wide array of international financing transactions. Thanks for joining, Francesco.
It's great to join you, Tom.
Francesco, I'm really looking forward to digging into the piece that you authored in Latham Watkins' PE Views titled Creative Uses of Collateral Present New Financing Opportunities for PE. Could you set the scene for us, perhaps? We saw a lot of companies seeking to raise financing during 2020, and not to mention the record-breaking run of PE deals since then, which has brought, I guess, fresh demands for deal financing. What's happening now?
Yeah, of course. So, Tom, the scene is set by the COVID-19 pandemic, which, as you know, temporarily crushed demand for a lot of companies and shut down their operations and really sent them scrambling for new capital to stay afloat and survive the precipitous drop in cash flows. So in that context, what happened was we saw a sudden spike in emergency financings, which tend to be a delicate balancing act between attracting new lenders into the fold without alienating existing creditors. So while navigating this tidal wave of emergency capital raisings, companies really became more creative in leveraging their assets. They came up with new ideas and forged new ways, new opportunities to raise capital, which our private equity clients and their portfolio companies might very well be able to use going forward.
You got it. And I expect you're going to tell me, Francesco, that this creativity is here to stay.
I think so. Regardless of economic background or, debt market buoyancy, I think these financing techniques are really here to stay. They demonstrated value in overcoming creditor skepticism during the period of economic distress that we've just been through, and they've opened the door to new ways of increasing leverage.
Got it. The suspense is building, Francesco. What else do we need to know?
Many listeners will be familiar with J.Crew, and not just for their clothing. In recent times, prior to the COVID-19 pandemic, the typical blueprint for raising emergency capital had been the J.Crew financing technique. With that strategy, with that technique, companies would take assets, shift them into unrestricted vehicles, and then pledge them from that vehicle to new money providers. However, the problem with the J.Crew technique was that it quickly took on markedly negative connotations. It frequently rattled debt investors because investors didn't like the siphoning off of valuable assets away from their original credit support package, and it almost always ended up in litigation and disputes.
Understood. And so that's now changed, has it?
The reaction to J.Crew hasn't. So when COVID-19 hit, sports car company McLaren tried to respond to its woes and address the pandemic-related liquidity shortfall by seeking to pull a J.Crew. So they decided to use an unrestricted subsidiary to raise debt against their beautiful head office and heritage car collection. And when they announced that that is what they intended to do, their bondholders revolted.
Crikey, completely understand that heritage cars are at the heart of many bondholders' interest in their assets. So what does it mean? Are we now seeing a more consensus-driven approach, Francesco?
Definitely. So borrowers reacted to McLaren's proposal, and they sought out different ways of addressing their liquidity needs. So they started to shore up their balance sheets and raise capital on a less confrontational basis without compromising the allegiance of their existing creditors.
So tell us, How are borrowers doing it, Francesco? Is this the big reveal?
It is a big reveal in the creativity with which companies started looking at their asset base and trying to parlay some of their valuable assets into new financings. But it wasn't really by creating something new out of thin air. What a lot of our clients and companies did was simply revisiting the concept of permitted lien or permitted security that you will find in virtually every credit agreement and bond indenture, which had to some extent been overlooked until then, in that it was only during the pandemic that we really saw companies starting to use that notion, that concept, to take valuable unencumbered assets that were not already pledged to their existing creditors and using it as collateral to secure new capital injections.
Uh-huh. So it was hiding in plain sight then, Francesco.
You might say that, Tom. That concept, that permission, tends to be narrower and probably less flexible than the J. Crew technique. Be drafted and intended for the purpose of allowing companies to raise incremental finance on a secured basis. Whereas the concept of unrestricted subsidiary that J. Crew used was really originally meant for different and less controversial uses. So the key difference here is that using concepts of permitted security and permitted lien really has an unassailable legitimacy to it that puts this technique of raising emergency capital well beyond the criticism of investors or the risk of legal challenge that has always been hanging over the utilization of the J. Crew technique. And it brings with it the advantage of certainty and a more friendly and constructive collaboration with your existing creditor base.
Wow, an amazing development during the pandemic. And Francesco, have you seen this being used? Are there examples that we can point to?
Many. One that I like to make often is the capital raises by Norwegian cruise lines during the pandemic. So they started pledging assets such as Great Stirrup Cay, a Bahamas idol that gave investors comfort to buy almost 700 million of their bonds, heralding what would soon become a much broader market trend. So what companies understood and realized was that so long as you were giving new creditors, new lenders, a sufficiently comfortable loan-to-value ratio, borrowers could literally raise capital and pledge any kind of family silver that they happened to have. So they started pledging all sorts of unencumbered assets, from idle ships to airport landing slots, from Caribbean real estate to frequent flyer miles programs.
Wow, frequent flyer miles and the Caribbean. Those were definitely the days. What about the new normal, Francesco? How is this creative approach to collateral likely to be used going forward? Is it being used at the moment on M&A deals?
Yes, Tom, and I think this is where it becomes really interesting for our private equity clients. So let's look at Asda, the recent buyout of UK supermarket chain Asda by TDR Capital and the Issa brothers. So that deal really illustrates the growing importance and wider application of these innovative asset-based lending techniques that we've been discussing until now. So the Asda deal was primarily funded by the largest ever sterling bond issuance, but it was also underpinned by additional slices of debt that were secured over real estate collateral. What happened was that in addition to the standard core LBO financing that we're used to seeing in most of our deals, Asda's buyers were able to parlay non-core valuable real estate assets, the petrol filling stations and the warehouse distribution centers, into standalone collateral that allowed them to raise several strips of additional interim financing which was essentially bridging to the eventual sale of those assets once the deal had completed.
So this creative approach to takeover finance, Francesco, it struck the right balance in the case of the Asda transaction?
It did indeed, Tom. It allowed the buyers to increase leverage beyond the typical boundaries of leverage lending without alarming debt investors. In fact, the 2.75 billion bond sale was the largest ever in the sterling market. It was oversubscribed many times over, and it priced at very tight levels.
Interesting. Well, what about the wider application to other buyout deals, Francesco? What should deal makers look out for to be able to tap into this emerging technology?
They can thoroughly scan a target's portfolio of real estate or asset base to try and identify pools of liquid, valuable collateral that can be detached from the business without affecting its long-term prospects, either, for example, by way of a sale and leaseback or by way of a permanent disposal.
And presumably, Francesco, you're going to tell our listeners that they should also work closely with legal counsel, aren't you?
Absolutely. Preparation is key, and clients and deal makers should work with legal counsel to review the existing financing documents to understand the scope for this flexibility, prepare asset reports, and produce in-depth structuring papers that credibly spell out the monetization potential of the segregated assets and the viability of a quick sale in order to be able to roll out this asset-based financing technique quickly when they get into prime time in deal execution.
Got it.
And Tom, what I think the Asda deal really demonstrates is that markets will give a fair hearing to investment propositions that ring-fence the security offered to core mainstream investors from separate pockets of collateral that can be set aside for incremental specialty finance. And I think this is really the upshot of the rollout of this new financing technique during the pandemic.
Nice. Great to make use of existing technology to bring about a consensus solution here, Francesco. It's been a pleasure speaking with you as always. Thank you very much for joining me today.
Pleasure's been all mine, Tom. Thanks for having me.
And thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Google Podcasts, Spotify, or anywhere else you listen to podcasts. If you'd like more information about the topics in this podcast, please email us from the links located in the show description. We hope you'll join us again next time.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 885 3rd Avenue, New York, New York, 10022-4834. Phone number 1-212-906-1200.